Hello all, this is Will, and I'm back with another video about trading and the stock market. Today I want to make a video on options trading. This is not my own presentation. I am planning to make some of my own Google presentations for later videos, but I wanted to go ahead and cover a few key concepts for the playlist that I'm making on YouTube, but I haven't had enough time to make a full presentation, so I'd like to give full credit to Brian Hyde for creating this presentation. I'm going to be using it and obviously speaking a few things that are of my own, but I'm going to be using his presentation. I will leave a link to it in the description. With that said, we can go ahead and move on with the video. Options are a tool used in trading in the stock market, and typically options are used by traders who are experienced but have less capital. This simply means that they don't have a lot of money, and the reason why is because options are very leveraged, but you can still get them for a cheaper cost. They're definitely a lot riskier. However, if you're an experienced trader, options can be a great tool. They can be a great tool for hedging, which I'll make a video on later. Hedging refers to, say you have a position of stock that you want to go up, and this is a position that you are keeping a lot of shares in say like an IRA or a long-term account, and you can use for instance put options to hedge that position, which just means that although you still want the original or initial position to succeed, you can use options as a tool to help you minimize loss if it goes against you. Options can also be used by larger institutions just because they're more leveraged. So let's go ahead and move on. So how do you make money with options? Here's an example here. The cost of purchasing 100 shares of Apple. Say Apple is at $400. If you were to buy 100 shares, it would be $40,000. This is a pretty hefty price, and it's something that not a lot of traders can afford. If you look at the return on investment for this, you see that it's 425 minus 400 divided by 400, which equals 6.25%. So what the cost of purchasing one call contract of Apple, which we'll get into on the next slide, that would just be $25. So that means $25 per contract. So if you were to buy 100 multiple contracts, it would be $2,500. And the return on this investment, if you take $40 minus $25 divided by $25, it's 60%. So as you can see, the return on the investment is huge when you're using an option contract compared to an actual stock. So what is an option? Options are derivatives of the value of 100 shares of a given stock. Unlike a stock, options prices fluctuate without any buying or selling. So, the two options that are found, at least in normal market trading, are puts and calls. You can use different combinations, different quantities, different everything to create and compose many different option strategies, which I'll do a video on later. But for simplicity's sake, there are really there's puts and there's calls. If you're long a put, that's the right to sell stock. If you're short a put, that's the obligation to buy. For calls, if you're long, that's the right to buy a stock. If you're short, that's the obligation to sell. So as you can see, puts and calls are sort of inverse to each other. This isn't completely accurate to say, but again, for simplicity's sake, you could say that they're inverse. To try and explain options further, I'll go ahead and try to do the basics of just calls and puts. So for a bullish call, the transaction is you buy the right to buy a stock from someone else at the option strike price. So for any option, whether that be a put or a call, there are, I would say, two main components that make up the option. There's the strike price and there's the expiration. With options, a new factor is brought into play. unlike simply owning stock. This is called expiration. If you buy one share in a stock, you can hold it for as long as you want. When you buy an option contract, there's actually an expiration date. This expiration date is basically when that option contract expires. Now, you are free to sell that option contract before the expiration date. That's why you have to keep in mind that there's no obligation for options contracts, but it's important to keep in mind that there is an expiration date. And so we'll talk about some other intricacies about that later. The second main component is the strike price. So this leads me into bullish call. And since you're buying the right to buy a stock from someone else at the option strike price. So an example would be, say there's a stock trading at $130 and you buy an option contract, a call, with a strike price of $135. So the strike price is $135 and you pay a fee to buy that call contract. You're buying the call contract and the stock is trading at $130. If that stock were to go down, you would lose money, as the call is indexing the stock's price and you bought it, so it's bullish. And if that stock were to go up, that option would increase in value. And if you wanted, you could sell it right there and make money. But a lot of with options, there's, when it goes into the expiration date, an option can either expire in the money or out of the money. So when you buy a call, say hypothetically you were to buy this call on March 26th and the expiration date was April 15th. If that stock, the said stock, was at 130 and your strike price was at 135, if that stock price rose to above 135 and you were holding and you held it through expiration, and say that stock closed on that expiration date that we mentioned in April above 135, let's say they closed at 137. Basically, the strike price is, since you're buying the right to buy a stock from someone else at the option strike price, you buy 100 shares of that stock for $135. That's the strike price. It's kept constant. So the way you make money with calls is either by buying them and holding for some time, and if the stock price goes up, you can sell the call to someone else early, or holding the call through expiration. If it's in the money, that call is then exercised and you buy 100 shares at the strike price. So that call option would be in the money in this scenario, or this example, because the stock price was at 137, which is above the strike price. So that means you buy 100 shares for 135, which would be, let's see, 1,350. I'll have to double check that, but that should be right. And the stock is actually trading at 137. So the way you make money is you acquire those shares for 135 when the actual stock's price is at 137. So basically there's a whole $2 difference. So again, I'll have to double check the math, but if you buy 100 shares at 135 and the stock is at 137, theoretically that should make you $200 in profit right there, because basically you're buying the stock for a cheaper price than it actually is. So that's the basics of a call contract and how a bullish call contract works. This allows you more leverage than a stock purchase, as mentioned. The profit potential is unlimited, and the risk is limited to the amount you pay in premiums. So the option contract will be a certain price. If that option contract was, say, what the price would be for the contract would be 25 cents, but this is in relation to each share. So if you see a contract worth $1.37, it's not actually worth $1.37, because the minimum amount is for each call is going to be representative of 100 shares. So that would actually be $137. If the call was 25 cents, it would be $25. It's basically just times 100 the price. So that price you pay, though, is the maximum amount you can lose. If you bought it, say in that same scenario, if the stock was at 130 and kept growing and growing a little bit for the first few days, you would be making some money and you could sell that contract back because the price would be higher. However, that option could expire out of the money, which means if you held that option all the way to the expiration date and it expired at 134, just under the strike price of 135, that option would actually expire out of the money and you couldn't exercise that, which means you'd lose everything you put in. So if you're holding if you buy a call or a put and you're holding it till expiration, you definitely want it to be in the money, because then it's exercised. It will most likely become worthless, which means if you hold it, it's a simple statistic. I mean, a lot of options traders, it expires worthless for them. So that's where the risk comes into play, because the closer you buy to the expiration and the farther out of the money it is, the faster it loses value. So that's why options trading can be risky, just because you can lose a lot of money quickly. You can make a lot of money because it's extremely leveraged. The stock could only go up a few dollars and you can make a lot of money. However, you can also lose a lot on the flip side. So right here we have a quick image that I want to insert, which demonstrates how a long put basically works. And I also wanted to mention, I don't think I really explained ITM, OTM, and ATM, or in the money, out of the money, and at the money very well. Really all that means is out of the money means how far away the strike price is. So if you bought a call that was ATM, that means it's like right at the strike price of the contract. So basically all you have to keep in mind is that when someone says ATM or close ATM, it means or close to ITM. That's an option that's like close to being in the money. Like the stock might be at 130, the strike price might be at 131. However, when someone says OTM, that means out of the money. So you can still make money with those options, but it's not really something you necessarily want to hold until expiration date, unless it's very, very, very far dated, which is called a leap contract. Because OTM, the stock could be at 130 and the call might be for 160. So that's really all you need to know for that. So let's get into a bearish put. So you are buying the right to sell a stock to someone else at the option strike price. So a put is basically the opposite of a call. There's the same example. You have the stock trading at $130 and you buy a put this time for $125. If that stock price went down below 125, so it breaks that strike price of 125 by the expiration date in April, that put option would be in the money. So basically, let's just say the stock goes down to 123 by April. The strike price is 125, and since it broke that, the put broke it, that means it's in the money and can be exercised. What this means is that you're basically selling a stock to someone else for $125, but the stock price is $123. So in this case, since there's a $2 difference, you'd also be making $100, and this is because you're selling a stock to someone else at a price that it's not really worth. You're selling it to them. It's basically a bad deal. And that's how a put option works. And so it's basically just the opposite of a call. And the same thing can happen if it expires out of the money. Say it goes down in the first few days from 130 and goes to say 128, 127, you'd be making money. But if it never breaks 125 by expiration, it'll lose value, which is time decay, which I'll talk about later. And if it expires out of the money, you don't have the right to sell that stock to someone else anymore. So it expires worthless and you lose what you bought the option for. So a bearish put can be insurance and hedge against decline in stock price. So that's what I talked about earlier. You could own 200 shares of a stock and you really want it to go up. But if you're thinking that it's going to go down, you can use a few puts to hedge your position and make some money off it going down while not having to completely exit your initial play. Maximum risk is equal to premium paid. So same thing when you're buying an option, the maximum amount you can lose is the money you put in. So, and here you make money if the stock goes down, as I said. Same thing with the bullish call. It will most likely become worthless. So now we're going to get into something a little bit more complicated, and that would be bullish puts and bearish calls. This refers to selling options, and instead of buying the options, buying the put or call, you're actually selling a put or call. Just like you would short a stock, which means you're actually selling shares, but you don't have the shares, so you make money if the stock price goes down. Here, you're selling an option you don't have, and you buy it back to close it. So for a bullish put, with a bullish put, you sell someone the right to sell a stock to you at the option strike price. So if you're selling a put instead of buying a put, you're selling someone else the right to sell a stock to you. So when you sell a put, the strike price, it could be the same example. Like say we've got the same stocks trading at 130. If you were to sell a put at 125, you would actually want that stock price to go up. And that is because in this case, you really don't want that put to go in the money, because then someone will be selling it to you for 125. And if it breaks and it's down at 124, you lose money. So with selling options, you actually receive a credit instead of paying a debit. So when you sell an option, say you sell that put for $125 and it goes up and expires out of the money, you keep the full credit, the premium. You're not actually paying anything, because if it expires out of the money, you're keeping that credit. So with selling options, you actually want them to expire out of the money, because this means that someone else can't, at least for bullish puts, no one else can actually sell that stock to you at the option strike price if it's out of the money. So it's similar to underwriting an insurance policy, and profit is capped at the amount of premium collected. So here's what's really important to keep in mind about selling options. Here, there is no capped loss. There's actually a capped profit. So if you sold that put and it jumped up to 145 or something crazy in the first day, you'd probably reach your max profit and you could close that position early. But with selling options, there is technically, I would say there's infinite loss for both, but technically with selling a put, there's a capped maximum loss because that stock can't go below zero. However, the max loss is usually extremely large on selling options, because if you were to sell that put for 125 and the stock went down way below that, someone is selling you that stock. You're forced to buy the stock if you hold it through expiration for 125, and if that stock is way down, you're losing a lot of money. So selling options, I would say, is a great tool if you know how to do it, but it's extremely risky because your max loss is a lot, and that applies to selling calls and selling puts. So we'll get into more examples later. So let's go into a bearish call. The transaction for this scenario is you are selling someone the right to buy a stock from you at the options strike price. So if you sell someone the right to buy a stock from you at the option strike price, it's basically the same thing as selling the put, except it's inversed. So for this, you actually, even though it's a call, and we initially talked about how buying calls is a bullish strategy, as in you want the stock to go up, if you're selling a call, you want the stock to go down. So if that stock was trading at 130 and you sold the call with a strike price of 135, you would not want it to go break 135. You would want it to stay below and expire out of the money, because then you would collect the full premium. If it broke 135, someone would be buying a stock from you at the options strike price, which means you would be losing money. So profit is capped at the amount of premium collected. As said, it'll tell you basically the max profit is the credit that you're getting for it, but the risk is infinite. And the reason why risk is infinite for selling calls and not selling puts is because when you sell a put, the stock can go down a lot and you can lose a ton, but it can really only go to zero. The stock price can keep going and going and going. Like obviously you can't have negative stock prices, but with a typical stock price, it can climb and climb and climb. There is no cap. So the idea with this is that the risk is infinite, so it can be extremely risky to sell naked calls. And the word naked in this scenario means that you're not buying calls with it, or you don't own shares in the company. You're basically like it's naked, you know. So if it's out of the money, you're fine, but if it goes in the money, you really have no hedge or protection. Like, the risk can be infinite. So, moving on, time erosion. This refers to theta decay, which is one of the Greeks. There's Greeks that are called theta, delta, and gamma. Delta and gamma are not as important to discuss right away, so I might make a later video on those. But theta is probably the most important Greek, and it's not extremely hard to understand. Theta decay basically refers to how an option loses value over time. So the simplest way to visualize this is, say the call price is at $65, and there's a lot of days until expiration. It's very far in expiration. If you think about it, in the initial days, if that call that you bought breaks the strike price and goes over, you're already in a lot of profit. So when you're buying options, you usually want to get rid of them as fast as you can. They're not really something that you actually want to hold, because they're just going to lose more value. You know, you're not going to be able to make as much money from it. So time erosion here and theta decay simply means that, say an option price shoots up, and when it shoots up, you make money initially. However, if it stays there and doesn't move any further, it will slowly decay. And if it's in the money, you'll still have the right to exercise it, but if it's out of the money, you won't. And so the best way to think of this is, like, if you have a stock that's trading for $130 and you buy a call with a strike price of $140, and it's slowly growing and growing and growing, and it's getting, say it could jump up in the first week to 139, so it's really close to the strike price. In that case, that call option would be worth a lot more, so it's a good idea to sell it. If it stayed at 149, 148, 147 in that range and never got close, it would basically be still out of the money. So that means it's slowly going to decay in price, because it's out of the money, and so it's going to be unable to be exercised by the person holding that call. So time erosion is a really big thing to think about with calls and puts when you're buying them, especially because you can make a lot and lose a lot from theta. When you're selling an option, theta actually benefits you, which is something I'll talk about later. Like, you actually make money from just simply time going on. But when you're buying an option, you lose a little bit every day, which is not what happens with holding a stock, because there's no expiration dates for holding stock. But when you have an option, you lose a little bit every day, at least when you buy the options. And so when you have a call or something like that, and it's about to expire out of the money, the theta will be extremely ramped up. And so this is why some options traders who trade during the day need to be extremely careful, because if you were planning to let's just say day trade a stock, and you were playing 0 DTE, which means 0 days to expiration, it means on the day of expiration you're buying that contract. And if you're playing, for instance, a stock that's trading at 200, and you buy in like the last 30 minutes of the trading day, you buy a call for 202. If that stock price goes up into 202, it'd be in the money. So you could either sell it or exercise and make profit. But the theta on that is going to be so extreme, as in, like, that call will be worthless if it's not at that strike price. So if it falls any, you can lose money very fast. So this is why, for people who are new to options, it's good to buy options that have an expiration date that's a little farther out, because the theta will be minimal, sometimes negligible at that point. But if you're buying them with a few days left till expiration, the theta can be extremely high, and you can lose a lot of money every day simply from time decay. So 85% of all traded options expire worthless. Another statistic. Options trading requires a rational mathematical approach to be successful. The concept of in the money is crucial, as we talked about earlier, and erosion gives option writers the advantage. So writing is another word that refers to selling, and as I mentioned earlier, if you're selling an option, although there's a lot of risk to it, you actually make money from the theta. And yeah, I mean, you basically make money from time decay, because if you think about it, you're not actually holding that option. You're promising to, you're selling it without having it. So you have to borrow it and buy it back you have to buy it back basically to make money. So in that case, that's why your time decay, that's why you actually make money from the theta. So here are some scenarios. I know a lot of this is extremely complicated, but it's good to start with a few basic scenarios of what you can use options for. So if there's a declining stock and it's in a downtrend, here you would want to buy puts. So if the stock is at 130, like we talked about earlier, you'd want to buy a put for 125, and you'd want that stock to fall. And you'd probably want to buy it for an expiration date that's a little bit more farther out, because it gives you more time. But in this case, you're going to want to buy a put. You can also sell a call, and here you would want to sell a call for a strike price that is higher. Although you can sell one that's in the money, you probably want to sell one that's higher, because if it's trading at 130, you probably want to sell a call for 135, 140, because you actually want it to stay below so you can realize the full premium. With a rising stock, you can buy calls. So if it's at 130, you'd want to buy a call for 135, and you'd want it to rise. You can also sell puts, and as the same thing I said with selling calls, you'd want to do the inverse. So you'd actually want to do a strike price that's below it, so at 125 or 120, and you want to stay above those so you can slowly make money from theta decay over time, and you can take that full premium when the day of expiration comes. So for flat stocks, you can write puts and calls simultaneously, which is called a strangle. Basically what this is saying is if you sell a call and sell a put at the same time, you can create a zone. And so say a stock's at 130, it's not really moving anywhere. You could sell a put for 100, and you could sell a call for 150. With a strangle that wide, the credit might not be that good, but it's a pretty safe bet, because as long as it stays between both of those, both of the options expire out of the money, and you get the full premium. But I think I'll make a video later on option strategies, because it would just be too much to start going through all that with this video. So for portfolio management, it's important to be a good accountant. FIFO, LIFO, max loss. This refers to first in, first out. Managing your positions, making sure you have plays that you're comfortable with the max loss. It's not a good idea really to play with infinite loss plays and selling options. There's a lot of brokerage tools that you can use, trading platforms, watch lists that can help you manage your options portfolio. So here are some tips. Trade on math, not emotion. Develop a system that tells you what to do, and don't bet more than 2% of your capital on one trade. So this means that you want to keep your max loss to a minimum. You don't want to bet that much money on it. Make decisions based on facts and rationale. If you're someone who's watching charts a lot, you might buy a call, see go up a little bit, get excited, and then it might sell off some, and you might be scared. You might say, well, now I'm not making money on that call anymore. It's important to think logically and think about the bigger scheme of things. If that option has a far out expiration date and you're bullish on it and you've done your research, there should be no reason why the stock's just going to tank. The stock should continue up. You should make money off that contract. So it's really important to manage everything, but also not mindlessly watch stuff. And you have to think smart about it. You have to make, trading is a very emotional thing, and so you have to be able to control your emotions and feelings when messing with the market. So some books to read: The Complete Guide to Option Selling, Quartier and Gross, and Trend Commandments, Michael W. Koval. And then this is the contact information for the person who made this presentation.